You're listening to Dollars and Cents. I'm Elaine Scollan with Blair Mantin from Sands & Associates, helping you get out of debt. On the line is Mark Fidgett, who's a Vancouver-based mortgage consultant and broker. He's got over 20 years of experience. He's a member of the Verico Mortgage Network and the driver behind www.advancedequity.ca. Mark, thanks so much for joining us.
Well, thanks for having me on, Elaine. I appreciate it.
Boy, oh boy, mortgages, housing, very, very hot topic all over the place. Buying a home and mortgages, super hot topic in the Lower Mainland. And we're so glad that you're going to be able to give us some mortgage industry insights into this. Let's talk about what should someone consider when getting into a mortgage? What's the first thing you should think about if you haven't done it before?
Well, one of the things is getting pre-approved, and one of the ads I see running by one of the big banks right now is how to get pre-qualified by calling a number and doing it in 60 seconds. And I think this is a big confusion here, the term pre-approved versus pre-qualified.
Yeah, because I saw that ad too, Mark, and I thought 60 seconds, how can they reasonably know very much? So I assume there's a big difference, pre-approved versus pre-qualified.
Well, huge difference, Blair. And I mean, you'd be surprised to hear how many calls I receive whereby clients are super disappointed when they're told by a bank that they're pre-qualified, and really it's just asking them a few questions, and from that, determining an amount that they qualify for. And obviously, there's a lot more to the pre-approval process than that.
So is it pre-qualification? Is that worth anything? If I'm going to complete a transaction, I've got a pre-qualification.
Honestly, Blair, it's not worth the paper it's printed on. I mean, nobody's looked at your credit, nobody's confirmed your income, nobody's looked at what other debts you really have. So there's a lot more to it.
Right. So the bank has a lot of work to do before they get to that final yes at that point.
Correct.
Right. Okay, so that's definitely interesting, Mark. Because again, I've seen those ads, and again, 60 seconds, what can you do? But if it seems too good to be true, it often is. I guess what are some other factors people should consider if they're looking at a mortgage in terms of how much mortgage to get? Because some people, they go in, whatever the bank will loan me, I'm going to take the maximum, but that's not always the smart way to come at it. How should you figure out so you don't end up with too much mortgage?
Well, one of the things we do with our clients, Blair, is we work backwards. So I sit down with a client and I ask them what their true comfort payment is. And a lot of people don't think of it that way. They're all sort of brainwashed into, what's my maximum mortgage approval? So when they really start thinking about what their comfort level is, we work backwards. And if someone says, listen, I feel comfortable with no more than $2,000 a month, then I work backwards and it's easy. I say, okay, well, that corresponds to a certain mortgage amount, and add that to your down payment. You have a purchase price. And, like I say, it's great to know your maximum mortgage, but that comfort level is really an important thing.
Because that's the one that you're going to get stuck with, right? That's the one that you're going to have to deal with every month.
Well, for sure. And I mean, we're in historically low interest rates, so it's really something to keep in the back of your mind in terms of where can my payments go moving forward. Because
it's easy to over-leverage yourself. Is that true?
Oh, for sure. I mean, I think, there's no doubt about it. We're in a very hot market, as you mentioned, and, it's easy to get enticed into paying more than you can really feel comfortable paying.
Yeah, Mark, I sit down with my clients quite often. We look at their mortgage, and a lot of them, especially if they're over mortgaged, they're on a variable rate mortgage. Maybe it's 2% now. And, we start to run through, well, if interest rates went up by a half point or even, a full percentage point here, that's a massive increase in the amount of interest that you've got to pay on a variable mortgage. Even a small, interest rate increase is going to have an impact. So I encourage, folks to really sensitize, take a look at different options about, if our interest rates rise, will I still be able to afford that type of a payment? I assume that's a discussion you would have with your clients as well.
Absolutely, Blair. And we kind of take it a little bit further. We sit down with them and they ask them realistically where they think mortgage rates are going to be in 5 years. And if someone says to me, well, realistically, I think, a 5-year term might be 4%. And let's say, for example, we're getting in at, under 3%. We try to encourage them to make an increased payment every year we increase it, so it goes towards principal. So it's basically a way of alleviating that payment shock, because let's face it, 5 years from now, it's pretty. I don't know about you, but if I was a betting guy, I would say the chances of rates being higher are pretty much 100%.
Yeah, there's only kind of one direction they can go, I assume here, right?
For sure.
Now, Mark, as people start to go through the journey of getting qualified for a mortgage, what are the main factors a lender would consider? And I wonder if there are some that are more surprising than others. I know one stat that surprised me to no end was that, more mortgages are denied based on unpaid cell phone bills than on other factors. So, the littlest bill can sometimes have the biggest impact. What do people need to consider when they're making a mortgage applications? What do lenders look at?
Well, you've mentioned something, Blair, that leads you to credit, and that's probably the most important thing and probably the first thing that lenders look at. And I think that takes us back to question number one in a bit. A pre-approval looks at your credit versus being pre-qualified doesn't. And lenders really look at your credit. They put it under a magnifying glass.
Right.
You'd be surprised to hear that 80% of people have errors on their credit report, 25% of which are serious enough to cause a person to be turned down for a mortgage.
Wow.
So one of the things,
Holy.
It's surprising, and most people don't even think about it. One of the things I encourage my clients to do is pull their own credit bureau at least once or twice a year, and you can do that for free by going to equifax.ca.
Yeah, there's fascinating stuff on there. I know when I pulled mine, Mark, I was one of the 80% that had some errors. I found addresses, I found different accounts. So, it sounds like from the stats here, odds are you will find something.
Absolutely. I mean, we've had clients turned down for mortgages because they've had a parking ticket in Vancouver that was sent to collections that they didn't even know about. And this is that's just a simple thing. I mean, you'd be amazed at what you find on there.
And finding it out at the 11th hour, that's not the right time because correcting these things can take a little bit of time. So, that could really scuttle a deal, I'm thinking potentially, right?
Absolutely. I mean, you're in the business. That credit is so important.
Are there some tips that you could give us to, I don't know, let's say, like boost the chances of you being approved? What can you do to improve your chances, Mark?
Well, one of the things I encourage clients to do is pay down their debt as much as possible because, when we look at someone's pre-approval, we're looking at what other debts do they have, and the more debt that they have, it's like a scale. It lowers their purchasing capacity. So, debt's one big thing. Keeping your credit score high is another thing, and a lot of people don't realize that they actually can do certain things to keep their credit going up. And one of the things is obviously, make your payments on time. The other thing that people don't realize is credit utilization is a huge thing. And what that is if you've got a credit card with a limit of, say, $1,000, the credit bureau, as a computer-generated score, wants to see you keep your limits at below 30%. And most people don't realize that. They're running at maximum capacity, and each time the credit bureau checks, it reduces their score.
Well, that's interesting.
So you want to have multiple accounts ideally and use them at 30% or less.
For sure, Blair, and that's a great idea. If you've got one card and you've got a credit limit of $1,000 and you're into it to $800, it wouldn't be a bad idea to get another card and to split the balances because that's going to definitely increase your chances of not being penalized in terms of the way the credit bureau establishes scores.
I know that at one point when we were looking at purchasing a house, we really looked at the idea of having a basement suite or a second suite as a bit of a mortgage helper. That's got to be an incentive for folks.
Well, absolutely, Elaine, especially in the price ranges we're in right now. So I definitely advise clients if they're not really hitting that price range that they need to be in, one of the ways to do, to sort of get higher is to look at places. And we like to encourage legal suites because more lenders will look at the legal suite income versus the illegal suites, although there's tons of illegal suites out there.
Yeah, no, fair enough, Mark. That was my mistake. I didn't mean to say illegal suites because, we don't want to encourage people to get illegal suited homes.
Yeah, no, I mean, there's lots out there, and everybody knows it, and it's kind of grandfathered in. But in terms of lenders and a lot of the, like CMHC, they're mostly looking at the income from legal suites.
Absolutely. That makes sense. That makes sense to me. Now, go ahead.
Oh, I was going to say, so Mark, implicit in the discussion we're having is, clearly you're an expert in the mortgage market. For folks that aren't familiar with the benefits of working with a mortgage broker, can you give a sense of, why would you work with a broker and how would you choose the right broker to work with as compared to dealing directly with the bank? My experience is that you tend to get much better results to working with a broker.
Well, absolutely, Blair, and that's a great question, one I often get. And People don't realize that banks make their mortgage money in three particular ways. One is, as most know, and this is the most popular way, is interest rate. And obviously, the better the interest rate the bank can get you to agree to, the more money they make. But two of the ways that a lot of people don't realize banks make big money is one in the penalty, and the other is in the renewal. And when we talk about the penalty, people often ask me, why do banks have posted rates? Because it's almost like the sticker price on a car. Nobody ever gets it. And what people don't realize is banks have the posted rate for one particular reason, and that's to calculate their penalties. And one of the things I always tell clients is, even if you take a 5-year term, most people don't expect to make changes within that 5 years, but life happens and things happen. And I tell you, I've seen some humongous penalties because of this.
So the advantage of a mortgage broker then, Mark?
Well, firstly, we're putting clients into mortgages that they're not using posted rates to calculate the penalty. The fact is we have access to probably the lowest mortgage rates in the industry. And one of the other things and this is really a shame, when you get to renewal time, banks are very competitive in the initial stages to try and lure you in. But when they do the renewal, one of the things they do is they send out a renewal document, and it's never their best rates. But the unfortunate thing about this is 80% of people simply pick a term, pick a rate, and sign it and send it back in, not even realizing that they're not being rewarded for what I would say is 5 years. If you're in a term of 5 years, 5 years of great business.
Exactly. And just in closing, something that a mortgage broker will do is, I want to remind you, they access the lowest mortgage rates that you can get in the industry. Mark Fidgett, he's a great guy, and if you want more information from him, access him very easily. His website is www.advancedequity.ca. He's a Vancouver-based mortgage consultant and broker, has loads of experience in this business. Mark, thanks so much for joining us.
Hey, thanks, Elaine. Thanks, Blair. Thanks for having me on.
You're listening to Dollars and Cents. I'm Elaine Scollan, along with Blair Mantin from Sands & Associates, who are experts in helping you get out of debt. We'll be back with more right after this.